Hello everyone and welcome to this session. In this topic, we will discuss the accounting period concept, which is a fundamental idea in accounting. Starting off with the definition of accounting period concept. So the accounting period concept explains that the life of a business is divided into specific time periods. Each of these periods is used to measure income, expenses, profit, and the overall financial position. At the end of every such period, financial statements are prepared. This allows business performance to be reported on a regular and systematic basis instead of waiting until the business comes to an end. For example, a business prepares its accounts every year rather than waiting until it closes down. Okay, so let's now understand what an accounting period actually means. An accounting period refers to the specific time span for which accounts are prepared. This period can be monthly, quarterly, half yearly, or yearly, depending on the needs of the business. However, in practice, most businesses follow a 1 year accounting period. So, for example, a company may prepare its financial statements for the period from 1st April to 31st March, completing whole 1 year. Okay, so why is accounting period concept required? The accounting period concept is required because businesses usually operate for a long and continuous time. Owners and managers cannot wait indefinitely to know how the business is performing. They need regular information to evaluate results and take decisions. Similarly, investors and creditors require timely financial reports to assess performance and financial stability. This concept makes it possible to measure profit at regular intervals. For example, shareholders review annual profit figures before deciding on dividend distribution. The accounting period concept plays an important role in accounting. It helps in determining profit or loss for a specific period. Secondly, it also supports management in planning, controlling operations, and making decisions. On the third, by dividing business life into periods, it becomes possible to compare financial performance across different years. And lastly, this concept also supports compliance with legal and tax requirements. So, for instance, comparing the profit of a firm for 2023 to 2024 with 2024 to 2025 helps in evaluating business growth. Okay, so the accounting period concept is closely linked with the accrual concept. So, what is accrual accounting? Under accrual accounting, income is recorded when it is earned, not when cash is received. And similarly, expenses are recorded when they are incurred, not when they are paid. So, this approach ensures proper matching of income and expenses relating to the same accounting period. Without accrual accounting, the accounting period concept would not work effectively. So, for example, salary for the month of March that is paid in April is still recorded as an expense of March. So, the accounting period concept directly affects financial statements. The profit and loss account shows income and expenses related only to the specific period. The balance sheet presents assets and liabilities as they exist at the end of that period. Only items that relate to the current accounting period are included in the financial statements. This helps to ensure that the financial statements present a true and fair view of results. For example, an outstanding electricity bill at year end is shown as a liability. Let's now look at the advantages of the accounting period concept. So, one major benefit is that it provides financial information on a timely basis. Instead of waiting for the business to end, results are available at regular intervals. It also helps in evaluating performance periodically. By reviewing results month by month or year by year, management can assess how well the business is doing. Another advantage is improved financial control and accountability. Regular reporting makes it easier to monitor expenses, income, and overall performance. This concept is also useful for both internal and external users of accounting information. Managers use it for planning and control, while investors and other stakeholders rely on it for decision making. For example, by identifying loss making months, management can take corrective action early rather than discovering problems too late. Despite its benefits, the accounting period concept has certain limitations. One limitation is that it relies on estimates and assumptions. Not all income and expenses can be measured with complete accuracy within a specified period. Because of this, the actual profit of a business may differ from the profit that is reported. Some figures are based on judgments rather than exact values. Another limitation is that certain expenses and incomes may relate to more than one accounting period. Allocating them correctly can be challenging. As a result, long-term performance may not always be fully reflected in short accounting periods. For example, depreciation is calculated using estimates which may not exactly match the actual wear and tear of an asset. Looking at the key points. So before we conclude, let's recap the key points of the accounting period concept. It is a fundamental accounting principle that underlies financial reporting. It divides the life of a business into meaningful and manageable time periods. This division allows regular measurement of profit and financial position, and it also plays an essential role in effective financial reporting and informed decision making. Okay, this concludes our discussion on the accounting period concept. We have seen how dividing business activities into time periods allows results and financial position to be measured on a regular basis. This idea is fundamental to how financial statements are prepared and interpreted. Thank you for listening. Take care. Bye bye.